All right, solving the problem of faulty mortgages continues. Looking for a solution, that is. The Federal Reserve Bank of New York may make banks buy them back from it. Bloomberg's Dawn Kopecki has the latest on that story, and she joins us now. So basically, they took on a lot of toxic assets, the Federal Reserve Bank of New York, during the crisis in exchange for...
Yes, also known as collateral.
That's right.
When J.P. Morgan went to rescue Bear Stearns, there was about $30 billion in assets that it looked at the Fed and said, thank you, but no, we don't want those. You take them. And they did, and a lot of those loans are going bad. They took on more bad assets when it tried to rescue AIG. And so now it's got about $70 billion in assets. A lot of people think a lot of those assets are not worth as much money as they were when they took them on.
I was going to say $70 billion by what measure?
Well, by the Fed's measure, so who knows? Fair value accounting and whatnot. But now the Fed is looking at these. The mortgages are defaulting. It owns some sort of a mall in Iowa or, Minnesota or something like that. So it's foreclosing. It's starting to foreclose on properties. And the Fed doesn't want to be in this position. So it's going through the loan documents, seeing if there are any violations of the agreements and telling these banks, take them back. We don't want them. These are bad. You probably knew they were bad, so here you go.
But you have got a great quote in your story, which is, why didn't they do this before?
Well, yeah, that's what analysts are wondering. That's what mortgage strategists are wondering. But as the housing recovery is not really recovering, these losses are becoming a lot more real. And now the Fed is under pressure by members of Congress to try to make sure taxpayers don't lose money.
What does this mean for the banks? I mean, surely they must have known at some point they have to pay the loan back and accept their collateral in return, and that they might be on the losing end of that trade.
Well, no one really thought it would come to this. Everyone was kind of living in some sort of fantasy world about mortgages. Property values would never go down. They'd always go up. Consumers would pay their bills on time. A lot of people are just walking away from loans that they can afford to pay. So no one thought it would get this bad and be this bad for so long. And as a result, the Fed is now seeing the reality of real losses and trying to do what it can to stem that.
I guess this is sort of the Fed seeing what this may have been like for a lot of individuals who were on the end of these loans at one point.
Well, and a lot of the real mortgage bond investors out there, they're trying to sue the banks to take back these loans. It's going to be this is going to be a long, ugly mess. It's going to drag on earnings for probably several quarters, if not years to come. It takes a long time for these assets to unwind. They have to go through each loan to see if the documents, like when you sign a mortgage, to see if you signed your name on the right dotted line, to see if you actually provided your income verification. They're going through these mortgage loans line by line, document by document, to see if there's any reason they can get for people to take the banks to take them back.
And these are losing value. I noticed in your story they're losing significant value.
Yes, yeah, and it's not just the mortgage loans. It's also the other asset-backed securities. It's the other collateralized debt obligations that are backed by credit card loans and commercial mortgage bonds and the like.
It's like a nasty game of hot potato.
Yeah, here, you take it.
Yes.
It's like the reverse of musical chairs.
It's going to keep lawyers. It's going to make lawyers a lot of money for a lot of years to come.
All right, Dawn Kopecki, I think that industry really needs it. Thank you very much.